The last week in the stock market has been one of the most volatile in recent history. While we've seen a bit of recovery, the market is still down nearly 9% year to date. I'm Nick and this is the Dividend Growth Income channel, and in today's video, I'm going to share 3 dividend growth stocks I've been buying and will continue buying here in April 2025. We're in the midst of one of the most confusing and unpredictable times we've seen in quite a while. And these stocks look undervalued right now. They pay strong dividends, have proven track record of growing those dividends year after year, and who can say what's coming in the days ahead, but I can be reasonably confident that my dividend income will only continue to grow. And if you enjoy content like this, make sure you subscribe to the channel, smash that like button, and drop a comment to help out the algorithm. All right, let's get into it. 3 dividend stocks I'm buying the dip on right now. The first stock I'm buying this month is Chevron, ticker CVX. Chevron's a staple in my dividend growth income portfolio, and with the recent pullback, the stock is now yielding over 5%. That's a level we've not seen since 2021, 4 years ago. I am not the type of investor who chases yield. It's never been my strategy. But I do like to buy quality blue chip companies when they're trading above their historical average yield. And that's how you lock in a solid starting yield and set yourself up for long-term growth. Currently, Chevron's yield of 5.04% is considerably higher than its 5-year average yield of 4.2%. Shares of Chevron are down nearly 13% year to date, and at the time we're recording, it's hovering right around that 52-week low. Zooming out over the last 5 years, Chevron has delivered a total return of about 100%, which is actually not far off from what the S&P 500 has done, 109% during that same time period. Valuation-wise, the PE ratio is at 13.3, slightly above its 5-year average, right in line with the energy sector average. But if you look through the lens of dividend yield theory, the stock looks undervalued, just like I mentioned earlier. If that yield were to revert simply back to that mean of 4.2 around that level, we'd be looking at a share price somewhere between $146 and $179. For me personally, when Chevron dips below $150, I see that as a strong buying opportunity. And right now in April 2025, we're sitting comfortably under that threshold. And here's the best part. Chevron scores a score of 90 on simplysafedividend.com safety rating, meaning it's highly unlikely we'll see a dividend cut anytime in the foreseeable future. And that lets me sleep well at night. Of course, when you invest in Chevron, or ExxonMobil for that matter, you're very much tied to the price of oil. It comes with the territory. So I keep this risk in mind, and I'm not going to let Chevron take up more than, say, 4% of my portfolio at any given time. Now, Chevron's current payout ratio sit at 69% of forward earnings, 58% of forward free cash flow. That's a bit elevated, especially compared to the 40% threshold we typically prefer for oil companies. But zooming out, this is a company that's been paying uninterrupted dividends for 113 years, going all the way back to its roots as the Standard Oil Company of California. And on top of that, they've raised that dividend for 37 consecutive years. That's not too shabby. The most recent dividend increase came this past January, a 5% bump, which is solid for a major oil company, already yielding over 5%. Chevron pays its dividend quarterly in March, June, September, and December, currently at $1.71 per share, which gives us a full year payout of $6.84 per share. The next ex-dividend date is estimated for May 16th, so mark your calendars if you're thinking about getting in. From a balance sheet perspective, Chevron is in great shape. They've got a net debt to capital ratio of 0.52 and a net debt to EBITDA of just 13%. That's very healthy for a company operating in a cyclical sector such as energy. Analysts also seem to like the upside here with an average price target of $175.54. That's 30% above the current share price. Bottom line, Chevron checks all the boxes: strong financials, consistent dividend growth, and global scale. With a recent dip, I think long-term dividend investors have a solid chance to scoop up shares at an attractive valuation. And keep an eye out. I'm going to be releasing a deeper dive video on Chevron in the coming week because there's really a lot going on with this company right now, and more than I can cover in just this video. So let's just move on to the next stock. The second stock I'm buying this month is NextEra Energy, ticker NEE. This is the only utility stock in my entire dividend growth income portfolio, kind of like how Chevron is my lone energy stock. And just like energy, the utility sector took a beating last week right alongside the broader market, but unlike tech and a few other sectors, utilities didn't really bounce back after Trump hit the pause button for 90 days on his tariff agenda. Right now, NextEra Energy shares are yielding 3.44%, and it's pretty solid for a utility stock, but really caught my attention is how it compares to the 5-year average yield of 2.27%. So once again, from a dividend yield theory perspective, NextEra Energy looks undervalued. When a stock is yielding significantly more than its historical average, it's often a sign the market is discounting it. And for long-term investors, that can mean opportunity. NextEra has two core segments to its business. It has a traditional electric utility business, Florida Power and Light, and a renewable energy business under NextEra Energy Resources. It's a utility giant currently valued at a $137 billion market cap. In the last month, shares have dropped 12%, now trading just a few dollars above the 52-week low. And zooming out over the last 10 years, investors have done quite well with NextEra. The total return sits at nearly 230%, outperforming the broader market. NextEra shares currently trade at a forward PE of 17.9, well below the 5-year average of 26.6. By dividend yield theory, if the yield were to revert back to its 5-year average of 2.3%, shares would be expected to trade somewhere between $90 and $110. The dividend looks secure by all metrics. Simply Safe Dividends gives it a dividend safety score of 90, rated very safe, highly unlikely to face a cut. And the earnings payout ratio is 60% with a forward payout ratio of 62%. Solid levels for a utility. And when it comes to utilities, we don't really worry about free cash flow payout ratios due to the capital-intensive nature of the business. So you do have to tolerate some dilution, though, since these companies typically issue shares every year to fund growth, and NextEra is no exception. NextEra's dividend growth history is truly excellent, which is part of why it's my favorite utility. They've grown their dividend for 29 consecutive years with a 10% raise announced just this past February. Management has also stated the double-digit dividend growth is expected to continue for the next couple years. The dividend is paid quarterly in March, June, September, and December, paying 65 cents per share at $2.27 annually. Look out for the next dividend date, estimated to be around June 2nd. As for the balance sheet, debt levels are acceptable for a utility. Net debt to EBITDA is 4.71. Net debt to capital sits at 57%. Finally, average analyst price target is 84.41, which implies over 28% upside from current levels. That would be something. NextEra checks off all the boxes for me: a proven long-term performer, rock-solid dividend growth track record, rare double-digit dividend growth in the utility space. With shares trading well below their historical valuation and the futures of renewables still firmly in play, I think long-term investors have a fantastic opportunity here. It's one that I am personally taking advantage of. Now let's jump to the third and final dividend stock that I am buying this month. And that stock is none other than Union Pacific, ticker UNP. While I don't currently own this one in our public taxable portfolio, I do hold a decent position of UNP in my Roth IRA. This feels like a solid opportunity to pick up a high-quality railroad stock with a wide moat at a dividend yield that's higher than its 5-year average. Not quite as dramatically undervalued as Chevron or NextEra, but still notable. The current yield is 2.45% versus the 5-year average of 2.2%. We're talking about a company that dates all the way back to 1862. It operates a massive rail network across the western 2/3 of the U.S., playing a critical role connecting suppliers and consumers. Over the past month, shares have dropped more than 10% and are now trading near the low end of their 52-week range. Zooming out, Union Pacific has delivered a total return of just over 150% over the last 10-year period. That's not too shabby compared to the broader market's 200% return over the same time period. The stock trades at a forward PE of 18.4. It's a nice dip below its 5-year average of 20.7, suggesting shares are undervalued at today's levels. Looking at them from a dividend yield theory perspective, we'd expect shares to trade somewhere between $220 and $268 if the yield were to revert to its long-term average. As for the dividend itself, it looks safe. Simply Safe Dividends gives Union Pacific a dividend safety score of 88, reaffirmed just 2 months ago, which suggests the dividend cut is highly unlikely. That's supported by a forward earnings payout ratio of 45% and a forward free cash flow payout ratio at 51%. Both of these are at a healthy level that leaves room for continued dividend growth. Union Pacific has an 18-year streak of growing its dividend, and it hasn't cut the dividend in 26 years. While growth has slowed a little bit in recent years, the 5-year average growth rate is still coming in at respectable 7.4%. The dividend is paid out quarterly in March, June, September, and December at $1.34 per share. That's $5.36 annually. So keep an eye out for the next estimated ex-dividend date on May 30th. From a debt standpoint, there's room for improvement. Net debt to EBITDA stands at 2.38, which is acceptable, while its net debt to capital is at 65. A little on the high side, though it has been trending down in recent years. One area where Union Pacific really shines is in its share repurchases. The company has steadily reduced its outstanding share count from 869 million in 2015 to 609 million today. That's a solid 30% reduction. And the average analyst price target is $255, which implies more than a 16% upside from current levels. So all in all, Union Pacific offers investors a dependable dividend, a wide moat, solid long-term performance, and a bit of upside potential, making it a steady blue chip option worth considering for any dividend-focused portfolio. So those are the 3 stocks I currently own and have been and will continue adding to throughout April. Each one has hit my personal buy price, but keep in mind that's my own research and strategy. Always do your own due diligence before investing your hard-earned money. And if you found this helpful, make sure to give the video a thumbs up, subscribe for more dividend investing content, drop a comment below letting me know what you are buying this month. Thanks for watching, and until next time, keep investing.